Indeed, we often say history does repeat itself, but what do we really mean by that? And how can we back that and make it look like a fact that it really is? The best example is right now, right here, happening right in front of our faces. And follow me on this journey as I'm breaking down on how history really does repeat itself. It's just upon us to use our five senses that we can realize and see what's happening right in front of us. And we can even look back in the past, what happened, what took place, what's taking place today, so we can anticipate what's happening in the future, what's coming to us, towards us. What's the privilege of anticipating the future? It is that you'll be prepared, right? I'm not sure about you, but I'm bold enough to claim that I'm sure most of us at some point in our lives have had the desire to be able to see the future, right? We're like, if I only knew, right? I would have made these and these moves. I would have done some things differently if I only knew. What if I tell you that to a certain degree of certainty, we can anticipate what's coming tomorrow and beyond based on today's current events. And when we look back of how these events took place before. So let's get right into it. As you look at the market today, you ask yourself the question, wasn't the interest rate cut yesterday? Why is the market still down? If the interest rate is cut, that means lower rates, that means easier access to liquidity. Shouldn't that mean the market should be actually, in the greens? Why are we down 4%? Why is the market down? Why are we at 34%, which represent fear under the fear and greed index? These are legitimate questions we ask ourselves. And these are not just us retailers are asking ourselves these questions, but if we even move on, we see that even the billionaire BlackRock CEO Larry Fink said nearly every person he talks to is anxious about the economy more than any time in recent memory. So this market situation is not bothering your average retailer, but everybody, large retailers, institutions, governments, everyone, more than in any recent history, right? So he further says that the global mood has shifted. People are uneasy. And it's not just your everyday investor feeling it, right? Fink wrote, I hear it from nearly every client, nearly every leader, nearly every person I talk to. That's what Larry Fink is saying. They're more anxious about the economy than any time in recent memory. I understand why, right? And the point he's making here is exactly what we started with in today's session. But we have lived through moments like this before. Beautiful. We've been here before. And somehow, in the long run, we figure things out. So that reflection, part acknowledgement, part reassurance, set the tone for one of the most closely watched letters in corporate America. So back to this statement right here, because this is how we start. We say, hey, we can anticipate what's coming because we've been here before. We've lived through this before. So if we go back and look back, what can we learn? What's the takeaway? Because we know that in the long run, we always figured something out and it always worked out. So what is there to be figured out? And how can we go from a fearful market like this that is bleeding like this and make sense out of this? So to kickstart, first of all, let's make sense of today. Why is the market bleeding despite Jerome Powell cutting interest rates? So it's really a straightforward answer right now. So, because the reason why the markets are bleeding right now, despite yesterday's interest rate cut, is because Powell said that because of lack of data, and this lack of data comes from the government shutdown, right? And this could affect December's rate cut decision. So the market is not bleeding because yesterday's interest rate cut. It's bleeding because the future, December rate cut might not take place because the government shutdown means that there won't be any data available for Jerome Powell to analyze and determine whether there'll be an interest rate cut in December or not. So because the government shutdown is still in place, this means lack of data. This could affect December rate cut decision. And this is the reason why the markets are bleeding. That's the simplest, straightforward reason, right? So now that we've got this out of the way, let's move on to something else. What else can we learn? Usually what we learn is that whenever there's easy access to money, we see investors moving towards riskier assets, stocks, cryptocurrencies, hitting all-time highs. But now, because of lack of decision, lack of data, government shutdown, and the possibility of no interest rate cut due to lack of data, come December, investors are moving back to safe havens, safer assets. What happens? Gold hits all-time high. So this is exactly how the economy works. If there's abundance in liquidity, people sell off their safe haven assets like gold and move over to riskier assets like cryptocurrencies, the stock market. And if there's lack of liquidity, people move to safer assets, right? Like gold. And then we see how gold rises in price and hits record highs. I want us to take away one more thing out of this article. And this is a very basic principle that I would like us to really understand. How the economy works. If we understand this principle today, community, then we will be able to anticipate what's coming tomorrow and beyond, because history often repeats itself, just like Larry Fink said here, right? Let's go back here. What did Larry Fink say here? He said that we have lived through moments like this before. You don't have to be wishing that you knew. We've been here. Be a historian, be a student of history, and you'll realize that everything we're faced with today, we've lived through it before, right? So let's just reflect on it. So this is what gets us right here. So let's go back right here. So what I want us to understand is this principle. It's between gold and US bonds. So this is where liquidity shifts, usually from gold to US bonds and from US bonds back to gold, depending on two things: easy access to liquidity and interest rates on the US bonds. So one commodity is gold. It's a store of value. However, it doesn't bear any interest. And during tough times where there's less liquidity and inflation, that's when people run towards gold. But during low interest rate, no inflation, people move towards US bonds. So let's go through this together. So in the past, the outlook for US real yields have proven to be an important driver of gold price, right? So since gold does not yield interest, but is considered risk-free, it primarily competes with other risk-free interest-bearing investments, above all US government bonds. So because gold is considered risk-free, it's competing with another risk-free asset. However, this other risk-free asset, that is the US government bond, is interest-bearing. It gives you interest. Gold does not. So now, because of this, if interest rates in the US rises, go up, right? Yield increases, the price of gold usually falls as investments in the precious metal becomes less attractive. Why would I hold gold that doesn't pay me any interest, doesn't bear any interest in times of high liquidity, right? And high yields? Why would I do that, right? So it's not an attractive, it's less attractive. However, conversely, if interest rates fall or inflation rise, real yields also fall, right? So if the interest rates of the bonds are going down, that means investors are no more interested in US bonds anymore because the yields are gone. The yields are falling, making gold investments more attractive again. This is a very straightforward and simple principle. And this literally is the base of understanding how the economy works. High interest yield, inflation means higher gold price. Gold is more attractive, right? If the gold price is increasing, you can imagine that means that the yields are falling, right? Making gold more investments more attractive. And if if the yields are high and they increase, it makes gold usually falls as well because it's not as it's less attractive. So once we understand this community, we are good, right? So let's continue. Now that we understand that, what else is a challenge in this industry? Right now, we see a major challenge, and that is BRICS. BRICS stands for Brazil, Russia, India, China, and South Africa. And there are many, many more partners and member states that joined the BRICS network. And they are now converting US dollar loans, debt, into the Chinese yuan with their partner states. So this is a major challenge for the US because, as we know, the US dollar is the global reserve currency. And a global reserve currency becomes a global reserve currency because it's the most used. It has the most utility on a global scale, right? The world is using the dollar on a large scale across the world. But now it's being challenged by the BRICS because they are now literally converting the US dollar loans into Chinese yuan. So this is a major challenge that is happening right now. And what is the US going to do about it? And we're going to answer that question right here. We're going to answer that question right here. Because in order to retain US dominance, the US has to do certain things. Keep the US dollar dominance, retain the demand for the US dollar, strengthen the bond market, and give the dollar utility so that it brings demand on a global scale. So the first thing you do to achieve all of that is what Donald Trump tweeted out, right? Is that the Federal Reserve should get the interest rates down to zero or less, right? And they should start to refinance their debts because it will make the debt repayments, interest payments cheaper. Right now, it's above $1 trillion, just debt repayments alone, on interest alone. And interest cost could be brought way down, right? So while at the same time, lengthening the term, we have great currency power and balance, et cetera, et cetera. So we all understand that this May, Jerome Powell is going to exit, and Donald Trump already lined up the individual that is going to replace Jerome Powell. And this individual is eager to cut interest rates radically. And we all understand that Donald Trump's aim is to cut rates down to zero. And we just had a lesson on what it means if the interest rates would go to zero, right? What happens if interest rates go to zero? We just had a quick lesson here. Now, let's understand something. Here, you have to choose between gold or US bonds because They all have, gold has its own properties and the US bond has its own property. The benefit of gold is because it's considered a safe haven. It's not as inflationary as the US bond is. However, the benefit of the US bond is because you're earning yield, you're earning a cash flow, right? You're getting yield, you're getting paid interest, you have a cash flow. So, how about if you have a commodity that combines gold attributes and US bond attributes, meaning you have a commodity that is considered a store of value or digital gold, digital oil. At the same time, you can stake it and it gives you yield just like the US bond does, however, without the inflation. That's where Ethereum comes into play, community, because Ethereum is serving the gold's attributes, which is considered a store of value. However, it's also a currency, on-chain currency, because without Ethereum, you can't swap, transfer, trade, or do any other activities on chain. You need the currency Ethereum. At the same time, it can be considered also a store of value because you can store your funds, your assets on Ethereum, as on the Ethereum asset. At the same time, you can stake it and earn yield, just like the US bond is giving out yield. However, without the interest, without the inflation. So this is what we mean when we say that in this debt-driven monetary system, Ethereum, the blockchain technology, Ethereum to be specific, is the solution to it, literally. Because right now, as we speak, liquidity is flowing between gold and US bonds, depending on the yield, right? So when liquidity is high, risk assets are more favorable. If liquidity is low, gold is more favorable. But now, instead of moving from one commodity to another asset, what if you have one commodity that combines both attributes? And the best candidate that does that is Ethereum. Ethereum is a store of value, like gold, but it's also giving out yield, like the US bonds, however, without causing inflation and loss of purchasing power. Now you have the tokenization, the future of tokenization. Everything is on chain. So now you already have an asset, a commodity that is a store of value and gives you yield, however, without the negative inflation effect. Now, with that information, let's move forward. Now, keep in mind, now that you have an asset that is a digital asset, it's a technology, it's a commodity, and it gives you yield when you stake it without the inflation. Now you have both aspects of gold and the US bond in one, where currently funds flow between gold, the commodity, and US bonds, the yield bearing asset. But now you have in Ethereum, you have two of those attributes in one. Ethereum is a technology, it's an asset that is a commodity like gold, but it's also yield bearing like the US bonds. There's never been an asset like that that has two-in-one capabilities and is also a technology at the same time that you can build upon, like an app store. You can build businesses, build applications, build smart contracts, build infrastructure on, like Ethereum. And this is exactly what makes Ethereum so special, so unique, and puts it at the front. Don't take my word for it. Let's take Visa's word for it. This is why Visa is partnering with, besides with Ethereum and with other blockchains as well, and is building infrastructures, guardrails for on and off ramping, and is to support payments, right, for 4 different stablecoins across 4 different blockchains. And you can also convert your fiat currencies into these stablecoins, right? And Visa also enables banks to mint and burn stablecoins. This is next level crypto adoption. And of course, their next competitor, MasterCard, is also making a move. MasterCard is in the works, in the talks of acquiring stablecoin infrastructure company Zero Hash for $2 billion. So both Visa and MasterCard are making moves to build infrastructures, even to buy out infrastructure companies if they can't, because they don't want to start from scratch. They're buying out existing infrastructure companies to take over the on and off ramping and enable or facilitate crypto adoption even faster. So we're seeing steps being taken to make this a reality, and keep the US dollar dominant, using blockchain, specifically Ethereum, as the solution to all of this. This leads us to something that we just discussed, right? So this is literally the perfect storm for Ethereum in the making, what we're just discussing. I'm using this specific tweet because it just matches what we just discussed. It's literally the perfect storm for Ethereum. So if we look at the market and we see how the market today is bleeding and all of this panic and panic sell and volatility, uncertainty, December rates might not be cut because the US is still shut down, and there will be no data, and this will affect or might affect, could affect the interest rate cut come December. So in the short term, the markets are volatile, yes, but in the long term, this is the perfect storm for Ethereum. And this is something we should understand, because all our 3 tokens are on Ethereum. And we're about to experience something that we've learned in the past, that we can take, that we can anticipate that is happening tomorrow and beyond, and how to prepare ourselves for this. So instead of panicking, let's keep this in mind. This is a perfect storm, community, for Ethereum. What are the perfect storms? Here are the 4 points. So first of all, Ethereum dominates the stablecoin market. This is no surprise. We know this, right? And we just saw Visa and MasterCard building, or in the process of buying out infrastructure companies to build the rails, predominantly stablecoins, for stablecoins. And stablecoins are dominated on Ethereum, with over more than 50% of the entire stablecoin issuance is on Ethereum alone, right? The second point is Ethereum dominates DeFi. This is no surprise either, right? With total value locked of over 100 billion and counting, Ethereum is by far is dominating, right? So there is no competitor in sight to challenge Ethereum's dominance in DeFi, literally by far. The third one is Ethereum dominates institutional markets. We just discussed this. That we just saw Visa, MasterCard. We know about Swiss Bankers Association. They're using Ethereum as well. We know about JP Morgan, BlackRock tokenizations taking place on Ethereum. JP Morgan's tokenized collateral network also on Ethereum, and we could go on and on, right? So if it comes to institutions, Ethereum is dominating that side as well. On top of that, we also see SharpLink, Bitmine, and Quantum. These are all DATs, digital asset treasuries, predominantly focusing on Ethereum as their treasury assets. And then finally, Ethereum, like we said, let's keep in mind, yes, it's an asset. Yes, it's a commodity, but it's a technology as well. So it's the world computer, just like the internet is. You can build on it. You can build businesses on it. You can build applications on it. And to transact, to trade, transfer, swap, you need Ethereum. So it's a layer, and it had in the last 10 years, it has 100% uptime. This is unmatched, and an unmatched security. So Ethereum is literally the world computer. It's secure. It has institutions building on it, infrastructure. It's dominating DeFi, and it's dominating stablecoin markets as well. Talk about real-world assets as well. So, and the beautiful thing is each of these 4 points is $1 trillion market cap network. So Ethereum has all 4 of them. This is why it's destined to be a multi-trillion-dollar market cap. And right now it's at below 500 billion market cap. So it has so much legs to move, so much room to grow as well, right? We're not into anticipation. I mean, we are not into talk about prices and all of that. However, just to finish what the tweet says, and this is why it's being predicted that Ethereum prices should be between 12 to 24,000, fair price based on Tom Lee. So moving forward, there's something else I want us to discuss. So as we know, within the last 24 hours, President of China and the President of US, which respectively run the largest economies in the world, China and US, have sat at a table and agreed right after their representatives met successfully in Malaysia. And now the two presidents met also together and came to an agreement, right? So this is the first step towards a peace in terms of trade wars. And this is what caused the markets to collapse in the first place. And having these two presidents come together and speak highly of each other and announce that they came to a solution that is beneficial to both parties, this is the first step to good news. And the markets is always sentiment, right? It's driven by sentiments. If it's good, the market is green. If it's bad, it's red, right? Very emotional. So this is the first step I want us to also understand that is coming. Now, to close out this session, one final thing I want us to understand. We saw how BRICS is trying to put together a situation where they are converting US dollar loans into Chinese yuan, right? So they're taking US dollar loans and turning them into yuan. The US is not just going to roll over and give up. So what do they come up with? They're using the whole tokenization scheme by taking the largest tokenization company, Securitize, and the oldest and largest bank in the US, BNY Mellon, that is a custodian, the largest, two largest institutions being leaders in their respective industries. And now they're creating, or rather launching, a tokenized fund that is backed by nothing else but a so-called AAA-rated collateralized loan obligations. Remember, the best way for the US to bring demand to the US dollar is to have to globalize the US dollar, globalize US assets, globalize, tokenized assets, stable coin, the US dollar. And the first step to do this, because the debt market is one of the largest, right after Forex market, which is $2.4 quadrillion. Debt industry is the second most liquid, over $400 trillion. The global debt industry is roughly $400 trillion. And this is getting ready to be tokenized and rated as AAA and used as collateralized loan obligations. Where is the US headed with this? Where is the market headed from here? This is where we say history repeats itself. We've been here before. And let's remind us as we close out this session. Where have we seen that before? First of all, to understand, we need to dissect and understand what is CLO. What is collateralized loan obligations or collateralized debt obligations? It's synonymous, the same thing. So let's clarify that first of all. What is that? So a collateralized loan or debt obligation is a type of securitization where a financial firm pools corporate loans, typically leverage loans. So it's debt, company debt. You pool them together. And these debts are leveraged, meaning they're not, you are taking a loan on top of these loans. So you're using loan to take up a loan. These are very highly risky products, right? And then you repackage them into different investment products. These are highly risky products. Don't take my word for it. Don't take my word for it. Let's look at history, what this meant. What did these products do? just exactly the same AAA rated products. In 2008 financial crisis, this very same AAA collateralized debt obligations were a class of securities that received the highest possible credit rating. However, they still failed spectacularly. This contributed significantly to the market crash, the 2008 crash. These products contributed to the market crash as investors had believed these assets were safe. However, they are not. These are debt instruments that are bundled together, such as mortgages, corporate loans, right? And what does that mean? Again, in 2008, debt securities were deeply impacted by the global financial crisis, with events like the bankruptcy of Lehman Brothers and the collapse of the market for mortgage-backed securities. These are other and collateralized debt obligations, causing widespread fear and volatility. So we are seeing history repeating itself right in front of our eyes. The same CDOs that caused the 2008 financial crisis are now being tokenized. The same products, AAA rated, exact same products that caused the 2008 financial crisis are now put out not by Lehman Brothers, but now by BNY Mellon, the oldest bank in New York, and the largest tokenization company in the crypto industry, are coming up launching a tokenized fund that is backed by these same products that caused the 2008 financial crisis. So what does this tell us, community? And the question here is this the blueprint for TradFi tokenization? This means that we are about to experience the largest liquidity rush ever, just similar to what we experienced prior to the bubble busting in 2008. So when we see the markets being so volatile, those who are patient enough, those who understand history enough, and see that the patterns are repeating themselves, and that before a bubble burst, before a financial crisis, there'll be a large wave of liquidity and an opportunity. And this is not financial advice. These are just my personal opinions. And these are just based on articles like I just shared with you, public information, and past history. And we're seeing the same products that crashed the markets in 2008 are now tokenized, being tokenized and placed on chain. And they'll be backed by huge liquidity. They'll bring in lots of volume, lots of liquidity. There'll be frenzy for these products. And the question, the purpose we ask ourselves, if we can see and anticipate the future, and we understand the past, and we learn from it, how can we position ourselves to make the most? We can anticipate that there's a lot of liquidity coming. But how will you benefit from all this liquidity that is coming if we can't survive this short-term volatility, if we panic sell, if we fall into the trap of being fearful and getting out of the market? This is the time to stand still. This is the time to learn from the past so that we know what's coming tomorrow and beyond. And I hope this session set us up to understand what's coming, and that we've been here before, just like Larry Fink said here. We've been here. We've already passed here before. And what's happening is that history literally is repeating itself right in front of our eyes. And we have lived through moments like this before. So let's learn from them. Let's position ourselves. There's nothing new happening here. I mean, it's down to the exact products that we see happening here. It's the exact product. Even the same name, they're AAA rated collateralized loan obligations. The only difference, these are tokenized. In 2008, they were not tokenized, but they're the exact same products that caused the 2008 financial crisis. They were known as the AAA collateralized debt obligations, one-to-one, exact the same products that significantly contributed to the market crashing because investors believed that these assets were safe. Now, here we are again, 17 years later, same thing is happening right in front of us. So what can we take away? We know that there'll be a rush of liquidity. We know that these are products we shouldn't be touching. We know that we should focus on ecosystems that will retain liquidity, will burn the supply to remain deflationary, if not scarce, that if it, in terms of staking, gives you staking rewards that are sustainable, not causing inflation, and that are using the volume that is about to hit the markets along with the liquidity. It's using that efficiently to to address the four challenges we faced within the industry. And that's where the BULLRUN ecosystem gets its strength from, and that's when it shines the most. So let's learn from the past. Let's learn from history and understand and anticipate what's coming right in front of us. So if we pay attention to the news today and see what's coming, and this is today, October 30th, this is breaking news that Securitize and BNY Mellon are literally tokenizing the same financial products, labeling them AAA, and calling them the exact same name that crashed the 2008 financial crisis. So we can anticipate lots of liquidity, lots of volume, lots of activities on chain. But instead of running to these volatile, highly risky assets, let's be part of an ecosystem that is sustainable, is efficient, does address the four challenges in the industry so that we can survive together individually and as a community this wave of liquidity and volume that is about to hit us. And we all are going to benefit from the rush, but not everybody is going to survive the crash. Only those with sustainable ecosystems, sustainable tokenomics that are addressing the four challenges we just discussed. That's the message for today, community. I hope the message was clear and straightforward enough for us. I want to wish you all a wonderful, wonderful rest of your week. And for the community tomorrow on Queen Debbie's YouTube channel, King George will be guests, and they'll be dissecting one of the podcasts videos that we discussed earlier we had, and it's going to be another amazing and informative session. So I highly encourage us to all support Queen Debbie on a new channel on YouTube, so that we can also learn from more from her and King George tomorrow based on the experiences that they had and how they analyze one of our podcasts that we had in one of our community events. With all of that said, I want to wish us all a wonderful rest of the week. And till we meet again, bye-bye, community.